everyone, and welcome back to another episode of the Globe Talks with Traders series, where you can learn the ins and outs of crypto trading. Today, I'm so delighted to welcome onto the show Richard Excell, Professor of Finance at the University of Illinois. So, watch on to find out about what catalysts you should keep an eye out for in the crypto markets that will affect price movements, and also how to trade in a bear market. Now, on to the interview. Hi, Richard. How are you?
Hey, Sunlight. How you doing today?
I'm great. Thanks for being on the show.
Thanks for having me.
Perfect. So, can you tell us a bit about your background and how you got into crypto trading?
Sure. So, I have a long background, right? Because I'm pretty old, but I started in the markets way back in the late 80s, early 90s. And I started in foreign exchange derivatives. And then I eventually moved into Asian emerging markets. And so I lived in Asia for most of the 90s, trading for FX, Asian emerging markets, and then global prop. And then in the early 2000s, I moved in back to the US and I moved into equities and hedge funds and long short investing, et cetera. Still staying within my derivatives background too. I got more exposure to quant finance and things of that nature. And so then, when I look at it and I've kind of been able to trade all the different asset classes around the world. And so when crypto was starting to get a little bit more popular, I'm hearing about it. And a lot of my friends that had known for years that had traded on the exchanges or whatever were getting into it. I was curious. I wanted to see why, what was going on here, why people wanted to get into it. Of course, most traders by their nature want to get into anything that has wide bid-ask spreads, right? Because that's a chance to make some money. But for me, it was really a lot more about, what is the potential for disruption here? And that's what really kind of attracted me to crypto in the first place.
Amazing. So I actually kind of want to backtrack a little bit. So as Globe is a derivatives focused exchange, can you tell us, as someone with more than a decade of experience in derivatives, what makes derivatives so attractive to traders as opposed to other types of trading?
Oh, definitely. Well, there's a few things I would say. First of all, like I said, I kind of was introduced to the markets via derivatives. And so for me, a delta is a delta is a delta. So I always think about things in terms of that frame. So I'm not naturally, a lot of people are naturally nervous of derivatives. That's not me at all. You oftentimes will want to look to the derivatives market first. But I think the other things that are interesting, at least for people who are just getting into derivatives, et cetera, is think of derivatives, think of options as a form of insurance, right? That's all they really are. And so, we're used to insurance. We're used to paying premiums for insurance. Sometimes from a regulatory standpoint, we have to buy insurance, right? We might have to buy insurance on our autos or our homes or our flats, wherever. And so we're used to kind of a one-sided market where we have to buy something and the price is whatever we pay. Maybe there's a little bit of competition, but it's usually overpriced. And options can also be a little bit overpriced as well, right? We know there's a risk premium implied versus realized. But the great thing about an options market is it's an insurance market where you can both buy and sell insurance. And so if you think the insurance is overpriced, you can go in there and sell it. And people can come in and use that insurance as a way to increase more yield, generate more yield. And so you can get protection on your portfolio from insurance, as well as generate some yield on your portfolio when you feel more comfortable about the world. And so I think of it from that simple standpoint of just being in an insurance market. And I think it demystifies a little bit of the jargon around the derivatives world that gets a lot of people nervous. But ultimately, I think for me, the really kind of the core way to think about the derivatives market and why it makes sense is whenever you're looking at investing in any particular security, crypto or, equities, fixed income, whatever it is, pick your asset class, whenever you're thinking about investing in securities, presumably you would have done your analysis of why you like it, what you think the reward potential is, what you think the risk is, right? What are the probabilities of those things happening, et cetera. And so without even thinking about it, you're already building in your mind a distribution of outcomes. And all options are trying to do is price a derivative based on the distribution of outcomes. And so you've already got this distribution of outcomes in your head because you've been thinking about this before you even choose to invest in a security. And so to me, options and derivatives are the natural implementation of your investment views because you have this distribution of outcomes in your head. If the distribution you have is really no different than what the market is saying right now, then maybe it's not even a good time to invest in it. But if you can find a situation where your view of what could happen is materially different than what the market's thinking, if you use options, you can certainly get a lot more leverage when you're right, or maybe a little bit more, insurance if you don't happen to be right. So to me, you can find the ideal way to implement your ideas in the options market if you're willing to look at kind of both sides of the market.
Amazing. Thank you. So throughout your years of, portfolio management experience, what have been, the most successful trading strategies that you've employed? Disclaimer, not financial advice.
Of course, yeah, I want to give financial advice. So, I mean, for me, again, my investment process, my trading process has evolved through the years, right? Because I've been in different markets. I started in markets that were very, very macro, right? FX, Asian emerging markets, et cetera. Then I moved to the other side of the pendulum. In the U.S. equity markets, or any equity markets for that matter, are very, very micro, very idiosyncratic. And so I've kind of seen it from both perspectives, and I've seen how how money flows in both of those types of markets. And so my process has evolved to the point where I try to incorporate all of that. I try to look at all these different factors. And what I look to do is I build it upon three different pillars. And that's the fundamentals, what is driving that asset. The next pillar is the supply and demand, or what I would call the behavioral aspects of it. How are people feeling? Are they nervous? Are they bearish? Are they bullish? Are they feeling more positive? What are the flows suggesting? What are the options markets suggesting? And then the last point of that is the catalyst. And so if you have positive fundamentals, if you have positive supply and demand or positive flows, and there's a catalyst that might even take us even higher, then that's when, all those things are ticking the box. That's when you should feel most confident and have your biggest positions. Conversely, if you have something where maybe the fundamentals are positive, but the flows are negative, there's no particular catalyst, those things kind of cancel out. And so that's when you might want to step to the sideline. And so for me, that's the core of how I look at all markets globally. That's the core of how I look at individual markets. That's how I look at individual securities. Or assets, is kind of breaking them down into those three different pillars and trying to think of what's going to, what's driving things and what's going to change those flows over time. And so naturally, especially when you use options, the catalyst part is the huge part, right? Because that's why people love the payouts of long option structures, right? However, long options can be a drag on performance if you're sitting there constantly having this time decay eat away at you. And so it's an instant gratification vehicle. So you need to be getting long options, particularly when you see a catalyst. If there's no catalyst, it might be time to sell insurance. You want to, of course, want to look at the relative pricing. But, to me, always having a focus on the catalyst, or what's going to get people to change their minds, or how do I see the world versus others? And, when are either of us going to be proven wrong? That's, to me, ultimately why I look at the catalyst, and that naturally then lends itself to the options front.
Amazing. So more on the catalyst later. But yeah, so it's all well and good knowing, your three key pillars of trading, right? So, but there always must be someone behind these pillars, right? So what makes a good crypto trader, and how does crypto trading differ from TradFi trading?
To be honest with you, I'm sure it'll make a lot of crypto traders cringe. It's not really that different at all. And it's no different. And when you look at cross asset versus asset, I think fixed income traders think that they're motivated and driven by different things than equity traders. And the reality is, when you step back and look at all of them, and I've worked in all those markets, it's ultimately the same thing, right? It's fear and greed ultimately drives trading. Fear, greed, and confidence. And so when people are, when the conditions are such, like for instance, easy money, et cetera, it's easy to be greedy. And so then you have to respect that. When there's a lot of changing winds, and there are a lot of moving parts, as there may be right now, or there has been in 2022, people tend to be fearful, and they trade and react accordingly, right? And there's a much more demand for the insurance side of it than there is for the tactical offensive side of options, et cetera. So really, there's not that much difference, and that's what I've kind of learned is, like, once you kind of understand what drives, what are the fundamentals that drive the underlying. The trading aspect of it, the supply and demand and the catalyst is very, very similar across assets. Now, one of the differences you might argue in crypto is the fact that it's a truly global marketplace, whereas most other assets tend to be more are isolated in one country. There's multiple exchanges you have to be aware of, et cetera. But that's not unique, right? And if you look at for instance, the U.S. options market in the 90s, there were hundreds of exchanges across the U.S. And so you were constantly trying to identify where the best bid and offer were, and if there was an arbitrage opportunity, et cetera. And now we've got the technology that kind of helps us aggregate that data even better than before. And so there really isn't that much that's new. I would say the biggest thing is really appreciating that it's a truly global product, more so than even like when we think of the other kind of global products, like maybe the VIX or the S&P E-minis or something that where people around the world kind of talk about it, that still they're not all trading it the same way. Crypto is a global product that people, institutional and retail around the world, are trading. So I think appreciating that is what is the key difference, because that ultimately you have to understand then what when we talk about those flows, those supply and demand, that's where that's going to really drive that difference.
Yeah, so actually to speak a bit more about the differences between the crypto market and traditional equities market, there's also the whole thing about, crypto is 24/7. Crypto market never closes. So what are the best times in the crypto market to execute a trade?
It's a good question. But again, FX markets were kind of 24/7 even before crypto markets were 24/7. So, again, it's not that different. So what's the best time to execute a trade? The best time to execute a trade is when you have confidence that you've worked through your ideas and your process, and you understand what the reward and the risk are, and you think the reward and the risk is favorable. And so to me, to be a successful trader, you have to have a disciplined entry level, and you have to have a disciplined exit level, right? You have to go into a trade knowing I am buying it for this reason, for this time horizon, and this is what I'm looking for. And if I'm wrong, I'm going to stop myself out. I think I look at it more from that standpoint than I do what time of the day, what day of the week, et cetera, to execute a trade. So that best time to enter, that time when everything lines up, might happen to work in the middle of the day when you're sitting there. It might happen overnight, but if that's to me where you can try to put in some disciplined limit orders with some disciplined stop losses or take profits. Excuse me. And that's the discipline is what makes a good trader. And that ultimately is what matters. I think the time of the day, it doesn't really matter so much to me. When I look at crypto, most of the liquidity, most of the real moves and interest happen during the Asian hours. And so that to me, that's the best time to really be trying to understand what the core of the market is thinking about. But that said, as a global product, global marketplace, I think we have to appreciate that.
So are there any kind of market tells that there will be an upcoming downturn in the crypto market?
Well, it's interesting. I think to me, when I think about tells in the market, and I talk about this a lot in the stuff that I write, et cetera, to me, that's what technical analysis is most important for. So I talked before about the fundamentals. I mean, I come from a background where I do both fundamental analysis and technical analysis. And to me, the technical analysis is really where you can start to see the tell. Because what's the tell per se? The tell is when you get a particular piece of news and the price doesn't move the way you expected it to move, or the price moves even more than you expected to move. And so you get a sense then for where the weaker side of the market is, or where the more crowded side of the market is based on that. So the tell to me is in the price action. And so to me, ultimately, one of the things that keeps me disciplined, the fundamentals of a story will drive me to the asset, but the technicals of this will tell me when I want to get in and when I want to get out of a particular asset. So I always look at technical analysis. I always look at the price action in relation to various streams of moving averages or moving average crossovers or RSIs, things of that nature, stochastics, and try to get a sense of what the market, the price action of the market is indicating, because that is ultimately where the tell is. Because in a global market, you can't possibly know what everyone's thinking, right? You know what your little corner of the world is thinking, because those are the people you talk to all the time. But that doesn't tell you what everyone else is thinking. And the great thing about price is the intersection of supply and demand. And so we don't have to anticipate what supply and demand are, really are. We can see that happening in real time, where the intersection of supply and demand is constantly happening. And as that is moving, as the price is moving, we get an appreciation for where things are and how they may be different than what we expected. And different from what we expected is usually where risk creeps in, but it's also where opportunity can come in.
Amazing. So, right, so technical analysis is a must then. So what would you think the merge will do to the market then?
Well, I mean, the merge, when we talk about catalysts, as we did before, I mean, that is the catalyst right now in crypto. I think that's why when you look at, of course, almost all crypto prices, or at least all the top coins you're looking at, are near the top of their 30-day range, with some exceptions. And so the broader tape is trading very, very well right now. But I think if you look at the ones that are the coins that are trading the best, you look at DeFi, look at ETH, and that's trading the best. It's got the best price action right now, and that's because there's a catalyst, right? And so now the question is, we know there's this catalyst. Sometime right now, the week of September 19th, et cetera, we have a kind of something to point to on the calendar. Now the question is trying to assess that supply and demand. So are people anticipating this so much that it's going to be, buy the rumor, sell the news type of thing, or travel and arrive, as you might say in the UK, et cetera? Is that going to be the type of, a price action we get after it? Or is it going to be something where, hey, this is everything we thought, and money's going to come in off the sidelines after that, because now there's this catalyst that will bring in some more institutional money, because now we're into the kind of the proof of stake. Is it going to be in some ways like a mini version of like a Y2K? Do people want to make sure it works before they kind of get involved? Are they worried about things not working? So I think it is the one thing on the calendar you can point to right now that says, hey, this is what we really need to be focusing on. This is where we need to be putting all of our efforts and focusing on this coin, and not getting so much caught up in the periphery, because this is ultimately, to me, the big driver for the rest of this year. And so I think this catalyst is a huge thing. Given the strength of price of late, I get a little bit worried about the notion that it's almost too heavily anticipated. And so my contrarian instincts come in, and I want to think about how I might want to take the other side of that. But I think it's still a little too early for that, because again, going back to that price action to tell, you can see that this is something that the crypto market, it's a really positive potential catalyst that has a lot of people who've been dealing with a bear market all year pretty fired up. And so I think it's something that you have to watch. But my contrarian instincts tell me that it might be something that we want to fade at some point, but it's still a little too early for that.
Absolutely. Yeah. So I was reading some articles. A lot of, traders seem to think that, straight after the merge, September, it's going to go all downhill from there. So what are your thoughts on that? And, given current market trends, do you have any tips for trading in a bear market at all?
Well, yeah, those are kind of two different questions, I think, but let me unpack it a little bit. So when we think about, we could all go downhill, et cetera, I think, this is, and I had written an article about this, when you're talking about, one of the big catalysts when we talked about last year was institutional money finally coming into the crypto space, et cetera. And, and that's a blessing. The article I wrote said it was a blessing and a curse. The blessing is, of course, you've got more flows, more potential tailwind into the space, which is what most people focused on. The curse is that that institutional money coming into the crypto space is going to treat the crypto asset class much like every other asset class, right? At that point, it's just a stream of potential returns with a volatility factor that you throw into your asset allocation model, and you decide how much you're going to allocate to it at any given time. And then the flows into and out of the asset at the margin are going to be a function of increasing or decreasing volatility. And so, I think the other thing that we have to realize is that especially those who are crypto native, it's been a very fast-moving, trader-oriented market. The institutional money is very, very slow-moving. And so traders oftentimes think that when something's going to happen, well, everyone knows about it, et cetera. that's very, very true in the trading world, but in the institutional world, even though people know this is happening, they're not executing on it until the certain signals hit, certain catalysts hit, until certain risk factors are out of the way. And so, understanding that there's this institutional money that may be sitting on the sidelines that are looking for this potential catalyst as a reason to, or something they're looking for to get into the asset that where they may not have been in there before. For me, I think I would tell people to be careful, because there might be a wave of money coming in that they're not really appreciating, that is solely looking for this. It might be swapping, institutions swapping out of some of the Bitcoin, which is their foot in the water, into a new product. So that's where I think that institutional flow, is really important. But now, kind of going back to your other question of kind of how to trade the bear market, et cetera. I think again that kind of goes to, you have to me, when I are going through a bear market, and unfortunately I've been through a lot of bear markets in my career, right? When your career spans decades, you kind of end up, you end up being in a lot of bear markets in different asset classes. And in bear markets, the most important thing is to focus on quality and liquidity. And so you always want to, when you're nervous, when you're sensing that other people might be nervous, when there's a lot of uncertainty, you want to be long the highest quality assets that are most liquid. And so you want to move your portfolio into those high quality liquid assets. And then as the volatility, as the risk factors in the market start to subside and come lower, then you can slowly start to take on more and more risk. It's about risk management. It's not about saying, hey, I think this asset is going to be the best one in the next 10 years. That may very well be the case. But in the near term, it's all about preservation of capital, and it's all about risk management. And so to me, when I'm going through a bear market, as we've gone through several bear markets in crypto in the last few years, you have to move into quality, right? And to me, when you see it, when you're moving into quality, ultimately everyone's moving into Bitcoin. Now there'll be people out there telling me that I should move into ETH for quality instead of Bitcoin, et cetera. I respect that, but you have to be getting out of the more fringe coins and kind of moving into the quality stuff. And then when things calm down, you can start to move out from there. But I think a bear market, you certainly want to move into that. Now the benefit for me, two things. I would say trading a bear market, as a trader, you have these disciplined entry levels, of course, but you also have disciplined exit levels. So to me, I stage into and out of different trading positions. So I look at moving averages. I mentioned technicals before. And so when coins are trading above all three moving averages, I'm fully long. I'm on full positions in. But as they kind of start to go through the different moving averages, and so roughly I look at 1 month, 3 month, and 1 year type of moving averages. As they move below each of those levels, I scale out of my position. So I'll cut it by a third when it goes below one month moving average. I'll cut it by 2/3 when it goes below 3 month. And if it goes below 1 year, I just get out, because I'm not really understanding the price action per se. And that's what happened early this year for most of those. And then things start to sell off, and you start to look for it. Now, one of the advantages of being in a Bitcoin type of product, because you can look at Bitcoin, you can look at Bitcoin futures, Bitcoin ETFs, et cetera, is that you can trade options against some of those things. And you can sit there, and we talked about selling insurance, especially when you get to lower prices. You can be long some of these products, sell some options against it, take in some premium that affords you the time to wait until you see the reason or the catalyst to get back into the position on the other side. And so to me, the first step is to get the quality. The second step is to have those disciplined exit levels. And then the third is to try to how do I want to be offensive in a bear market? And being offensive in a bear market will typically mean how can I take some option premium out of the market while I wait and kind of bode my time to get through the bear market.
Amazing. Thank you. You touched a little bit on, what you do and you personally do in a bear market. So can I ask, how have you personally fared this market? And, if you made losses, how did you recuperate them?
Well, it's through what I talked about. So yeah, there definitely were losses, certainly early on, right? Whenever you're getting stopped out of positions, you're accumulating some losses, and so that was definitely the case. Some of the more volatile coins stopped me out earlier, and then the first moves were into again, into the quality. Ultimately, the ultimate quality, of course, is stable coins. And so you try to move into that, right? And so there definitely were some losses early on. I ultimately moved a lot, in the first quarter of this year into Bitcoin type products, so I could sell options, and so I could try to accumulate and get back some of those losses. And so then now the question is, have moved into ETH a little bit just because of this catalyst. But the question is how to look at this. But yeah, there's losses, but to me, I think again, when I'm looking at things, I'm looking at the reward to risk ratio, right? And so if I can find 3-to-1 reward to risk, I understand that my risk is that I'm going to lose 1 unit, whatever that unit is, but hopefully I'm going to make 3 units, right? And if we look at 2020, we look at 2021, these were years when you made even more than 3x your money, right? And so they're accumulated gains that you have in there. So when you have losses in a particular year, you have to kind of step back and look at the big picture and say, okay, I've accumulated some losses this year, but it's because I've made some gains in these previous years. And so you're kind of looking at your average returns over time. But more importantly, I think as a trader, as an investor, is you don't really want to focus on the rearview mirror. You want to focus on what's going on ahead. When we invest in something that has potential, right? We don't invest in something that's happened already. And so the human nature of it is to really kind of, it's first of all, the human nature is loss aversion. So most people don't even want to take losses, which is why they end up writing something down 80% because they never wanted to sell it. I'll be more than happy to sell something down 20 to 30%, knowing it might go down 80%, because then at least I've saved myself 50% on that. So I think the first thing is to avoid loss aversion. But the second thing is people forget about, that we're in this for the long haul. So now that's where you're thinking about, okay, now everything is really kind of corrected to very, very low levels. So now you really want to be thinking about back to the fundamentals. How do things look on a multi-year basis? Where do I think the most opportunity is? And again, it's assessing that reward to risk. And I think if you're constantly going through that and constantly updating your models to try to assess the reward to risk, you're going to find a series of the best bets. I think the biggest difference between retail and professional trading is the risk management. It's not, a lot of people think professional traders are right all the time. And I can tell you they are not right all the time. If they're right 55 to 60% of the time, they're a hero. The difference being the risk management. If I think I can lose 1 and make 3, and every time I'm losing 1, I'm getting out. But every time I'm making 3, I'm finding a way to stay in the trade and maybe let it run a little bit further. If I'm right 60% of the time, I'm going to net make money over time. And that's you just can't afford those big drawdowns. And the retail tends to be more susceptible to the big drawdowns, which means it's just that much harder to make back your money. Now in crypto, we've been bailed out several times, right? Because it's gone up so much that we have been bailed out from holding on. But I think, especially as institutions come in, it's a little bit more difficult to do that. And so I think you just want to try to avoid the drawdowns as much as you can. But excuse me, when everything's been drawn down so much, now you just want to make sure you're in the best things going forward. A couple of things, especially in the bear market, when we talk about moving into quality. One of the things that I really kind of picked up the most when trading in equity long short in my early days in hedge funds is looking at the relative price action, the relative value of 2 different securities. And so, classically in equity long short, we think of it as 2 different stocks. It might be Apple versus Microsoft. It might be Apple versus Samsung. It might be BP versus Exxon, whatever it is. It's 2 different things that should be fairly highly correlated. That might be disconnected at a given time. And oftentimes you'll find that they tend to stay within relatively narrow bands over time, absent some sort of major catalyst. I think when we look at crypto right now, that's absolutely what's happened over the last 18 months. If we're looking at Bitcoin versus ETH, or if we're looking at Solana versus ETH, which is interesting. So when I look at Bitcoin versus ETH, it's been in a fairly well-defined pattern, and at this point right now, pattern over the last 18 months. And at this point, probably because of the catalyst we mentioned with the merge coming up, when we look at ETH as trading at the very high end of that relative range to Bitcoin. Now, the price action of ETH has been much, much better than the price action of Bitcoin. So clearly people are getting much more interested in it. That's why we're at the high end of the range. But knowing that it stayed within this range for the last 18 months, it's something that again, we think about, because mean reversion is a pretty strong tendency, especially in things that tend to be highly correlated. Now, on the flip side, when we look at relative value trading, if we look at something that should also be highly correlated, for instance, Solana versus ETH, this has been kind of in a descending triangle pattern for the last 18 months, where the Solana was very, very hot middle of last year, and there's been a series of lower highs that have been kind of going on for the last 18 months. But every time we kind of pull back to the lowest levels, there's a floor, there's a level where people will swap out of ETH into Solana. And so in that case, we're very close to that floor at this point as well. And so both of those on a relative value standpoint, and again, this is just a very short-term trading idea, mean reversion. Both of them are pointing to getting long either Bitcoin or Solana relative to Ethereum, just looking at this relative value concept. And so I think that's something to think about, that traders will often think about as they're moving around the inventory within their portfolio. And so I think that to me, I look at that and say, and suggest, it gives me something else, a signal to help me when things might be getting a little bit too far stretched in one direction.
Amazing. Thank you.
Yeah. Maybe the other thing I would talk about is one of the benefits that I've had in looking at all the asset classes is you can start to see some of the same things that drive all of the asset classes. And as I tell my students, I'm like, the one product that drives absolutely everything that we do in the world, whether you want to believe it or not, is the 10-year US interest rates. So everything trades at some spread to the 10-year US interest rates. You can look at different sovereign government debt trades at a spread to the US interest rates. You look at credit instruments traded at a spread. You can compare the equity markets, because the multiples on the equity markets are inversely correlated to the 10-year yields. You can look at the futures markets. You can look at commodities, and clearly the level of contango is driven by the interest rate curve, et cetera. And believe it or not, crypto is also driven by these interest rates. And I'll tell you how this becomes fairly obvious. So if we think about, and it's hard to take your mind back to 2020, really, because that's a couple of years ago now. But if you look at what was going on in 2020, as we're coming out of COVID and central banks around the world were ultimately printing more money, but the money supply was going up. But they're also investing that money in the markets, and so they're driving interest rates lower. They're driving bonds higher, the yields lower. What happened is we had this insatiable demand or quest for duration across all asset classes. Now, the poster child for this was the amount of negative yielding debt in the world, primarily in Europe. And so that hit a peak of around 18 trillion, I think, towards the end of 2020. And so that was just a case where, from a regulatory standpoint, institutions had to be long duration, whether it be banks, insurance companies, pensions, et cetera. And so what do those institutions do? Well, they go out and they buy every bond that you can possibly buy in the world. Then they're buying credit instruments, et cetera. And so what does that do? It squeezes the people in the credit markets into the equity markets. So what do the equity markets do? They buy all the duration that they can in the equity market. And duration in the equity market is the highest growth stocks that you can think of. Those that generate no cash flow right now. They're ones that all the value comes from the implied growth going forward. It's the innovative tech stocks, et cetera. And so they squeeze that as far as they can possibly squeeze that. And so what happens after that? Well, then the people get squeezed out of their long tech stocks. What do they look to? They go into crypto, because that's another high duration, long duration asset, because all the value is from the implied future growth. And so now crypto markets get squeezed higher, et cetera. And so it kind of went through in a pattern you could really recognize, that we could see the squeeze in duration starting in fixed income, going into credit, going into equities, then going into crypto. And so all of it came from this demand for duration that happened globally across assets. And so with institutional money coming in, crypto investors have to be wary of that. Well, what's happened really over the course of all of last year and into this year has been the unwind of that, right? As central banks are raising interest rates globally, what's happened is that there isn't that demand for duration. Duration's going in the other direction. Yields have gone higher in all the major markets. And so we've seen the amount of negative yielding debt come down from 18 trillion to closer to 4 trillion. Still too much, but it's come down quite a bit. We've seen credit markets collapse. We've seen equity markets collapse, and we've seen crypto markets collapse. And so the point being is that there's one measure, if you will, if you look at yields, which is being dictated by central banks, economies, and ultimately regulation, it's really affecting all the markets. And so as much as we think that there's a hugely idiosyncratic market in crypto, it's really being driven by some of the same factors that's driving all the other asset classes too. And so I think that's something that crypto investors have to appreciate, especially as we see more and more institutional money coming into the space.
Perfect. Thank you so much. Now, to finish off, what are your next steps to kind of weather the storm that is 2022?
Yeah, there's still a lot that's going to go on, right? We have a lot of risk in the world, right? We still have wars going on in Europe. We have concerns of wars going on in Asia. We've got a lot of political risk in the U.S. And so the risk premium in the world is quite high, as it should be. And so that's going to make people a little fearful to take big positions right now because of that uncertainty. However, knowing that, we still have a lot of potential catalysts. Now, we talked about the merge catalyst coming up. That's right there on the horizon. We have to be paying attention to that. But I also talked about the idea that all of our asset classes are being driven by central bank yields, which are being driven by inflation. And so I think when we look at it, all the central banks around the world are getting together at the end of August at the Jackson Hole Economic Symposium. And we're going to hear some things there that's going to give us a pretty good indication of what they're going to be doing for the rest of this year into next year. And I think that's going to really start to impact all of the markets. It's going to start with the fixed income, but we're going to see it ripple through all the markets. You probably won't see it so much in crypto because we do have this catalyst. But once that catalyst is out of the way, it's going to really kind of color how people respond and react to that catalyst. And so to me, when I look at the end of August into the middle of September, which is also a time when in an equity market, you're getting a lot of conferences and people starting to talk about earnings in the third quarter. There's just so much in the way of catalysts that's going to happen from the end of August to the end of September. It becomes what I would say is a really, really interesting trading environment. It's not a really, really interesting investing environment because it's going to be hard to know how people respond to this and how much confidence they're going to have in this, given the uncertainty and uncertain environment. But sometimes markets don't, we have to appreciate that sometimes markets don't trend strongly in one way or the other. Sometimes they just go sideways for a long time. And I think that's what's kind of lost on a lot of people is that markets tend to go sideways for a long time, more often than we think they do. And we might be one of those periods where we're just in a range trading environment that you want to trade both sides of it. And that's what I'm looking to do really is try to find ways where I can trade both sides of this market and try to make some money while we are kind of churning through a lot of these potential catalysts and the potential risk, and use that money then that when the signs become more clear that we are going to start trending again, I have a little bit more bankroll to invest in those trends.
Absolutely. Thank you. Thank you so much for watching. If you enjoyed this video, don't forget to give us a like, comment, and subscribe so you never miss any alpha. If you'd like to trade crypto, don't forget to check out Globe Exchange. Happy Globe trading, and I'll see you next time. Bye.